Hey guys, it's Dan here. In this week's video, we will talk about hedge funds. So, what exactly are hedge funds? In this week's video, you will learn three things: the hedge fund mechanism, how hedge funds make money, and are hedge funds useful or are they rather dangerous? Ladies and gentlemen, let's get started. The best way, in my opinion, to understand what a hedge fund is to understand that there are two different types of investors. You have active investors and you have passive investors. Let's start with the passive investors first. The goal of a passive investor is to replicate the market. For example, the mutual funds or the pension funds, all the big companies that manage your pension in the long run, this is what they do actually. They're gonna, for example, if you take the S&P 500, which is an aggregation of the 500 biggest, most profitable companies in the US, they will try to copy or to replicate exactly what happened on the market and on the S&P 500. For example, if last year the S&P 500 went up by 16%, then the mutual fund or the passive investor will also go up by 16% because it's kind of a clone of the market. So this is a little bit more conservative than the active side we will talk about and the hedge funds that are on the other side. Here on the passive investor side, it's all about the buy and hold strategy. You understand that for your pension, of course, you want to invest long term over 20, 30, 40 years. So each month you're going to buy in and hold it for a very long time and profit of the increase of stock prices and the dividends. So this is the idea here, and everybody has access to passive investing through several platforms and several mutual funds. Even if you have $200 a month, you can easily invest inside through various platforms. Now the other side, and now let's jump into the topic of the hedge funds. Actually, hedge funds are active investors. What does it mean? It means that they're trying to beat the market. You see here, as a passive investor, we were trying to copy, to replicate the market. Here, the goal is to beat the market. So you see that you are more aggressive from the start, actually. Let's say if you want to beat the S&P 500 and that the S&P 500 delivered 16% last year. In this case, the goal is to have 16% because you are cloning. And in this case, as an active investor, as a hedge fund, you want to beat the 16% and let's say have 20, 25, 30%. So it's much more aggressive, much more short term. And that's why in this category, actually, you are buying and selling frequently, and you do a lot of research because you you want to find the diamonds and want to drop the losers, basically. So the idea actually here, it's more like a rich people club, the hedge funds, because the idea behind it is that actually when you look at the criteria to become an investor in a hedge fund, usually it's like 1 million of wealth and about $200,000 a year as a salary. So you see that's the first very big difference: passive investment, active investment, and the hedge funds, which are clearly here in the active, more aggressive side. So now, what happened with the Reddit incident and why was it so special actually? It's because through various trading platforms actually, the individual, the you or the me, who usually only has access to the passive investor side actually, was able to beat the hedge fund guys actually in their own games. And as you know, hedge funds are professionals, and we as normal investors are of course amateurs. And what happened actually with the Reddit story and the Robinhood story is that a lot of investors were able to gather together and by thinking, okay, let's beat the investors, beat the hedge fund by doing the exact opposite of what they are doing. Okay, now that you briefly understood what's the difference between active and passive investing, let's look exactly at how a hedge fund works before we talk about how a hedge fund makes money. So how does a hedge fund work? First of all, on top of the hedge fund, you have the investors, which are also called limited partners. As I mentioned before, that's kind of the rich people's club, because you need a certain amount of money to enter the game if you want. It's like a big poker game for rich people with the contract and everything. So here, a lot of rich people will pool their money if they want to participate in this hedge fund, and there has to be a common goal behind it. In what do we want to invest? And once they have agreed in what they want to invest, they are pooling their money together, and they will find a great professional fund manager, and they will fund this guy and agree on a strategy and on fees. That's very important because that's, of course, how they're gonna make money. We will talk about it in a second. But now the question is, once everything here is set up, what is going on? Actually, these guys trust the professional fund manager, and the professional fund manager will invest in related to the strategy. If the strategy was to invest in stocks, bonds, and real estate to beat the market in different ways, well, then the fund manager will find the best stocks, the best bonds, and the best real estate that will be able for the hedge fund to beat the rest of the market. Because otherwise, if you're just replicating the market, there is no reason you should invest in a hedge fund. The big question, how does a hedge fund make money? Well, actually there are two ways, because there are two parties involved. As I mentioned, there are the investors and there is the professional fund manager. Let's start with the professional fund manager. There is a rule in hedge funding called the 2 and 20 rule. What does it mean? It means that this guy who is a professional fund manager, he gets 2% of the assets invested and 20% of profits. That doesn't sound like a disaster, but it is actually for finance in general. Because imagine the fund invests $1 billion. That means that the guy here, even if he doesn't do anything, just investing the 1 billion, he already made 20 million without even, it's not even performance related here, the 2% asset. Then comes on top of it something which is related to profits, of course, and that's a 20% cut on profits. So there has been a huge debate here, of course, because the 20% on profits sounds reasonable given the fact that this guy is a professional manager and is managing everything. But the 2% of assets, that's the big deal, and that's why there has been a lot of controversy going around hedge funds, because a lot of investors lost money and this guy here still made a lot. So that's the 2 and 20 rule, which is very important. But now let's talk about the end game of a hedge fund. So that would be here in the investment side. So I will show you now different strategies how this guy beats the market, which is the goal of a hedge fund. So let's get started. The first strategy hedge funds use to beat the market and to be better than the market is called leverage. What is leverage? Sounds fancy, but actually it's just using debt to buy assets. I give you a very simple example here. Let's imagine I'm the hedge fund and I'm investing into stocks. I have agreed with my investors that I will invest for them into stocks. So I could just invest the money that I've received and just buy stocks, and that would be very simple here. I invest the $100 I have received, and imagine at the end of the year my stock went up by 10%, so I get a 10% return, right? So what I made is actually I made $10 here, 10 out of 100, so that's a gain of 10%. Very simple. So now how can I beat this? Very simple, by adding debt. So imagine the same, I invest $100 plus $50 of debt, bank loan for example, or other more complicated forms of debt. In this case I have invested $150 in this stock. It still gives me a 10% return. So in this case I invested 150, 10% of 150 is 15%. So as you can see, by adding debt, by adding leverage, I have increased and I was able to beat the market. So what's the downside here? Of course, well, more risk, of course. Because if this whole thing blows here and it doesn't work out and you're not making any return, well, you're still owing $50 to the bank in this case. So this is why it's much riskier, and that's why hedge funds blow up if they go, if they have too much leverage and if the entire thing goes bad. Another strategy hedge funds use to beat the market is called the long-short strategy. To give you a very famous example, and this is what happened actually with the entire Reddit thing, is hedge fund started to short sell a very specific stock in this case. What does it mean, short selling? It means that a hedge fund sold a stock that it didn't own. Yes, you can actually do that. Actually, that's a very long history back then, but actually 200 years ago, when people were still on their horses, you could sell a stock with a specific license because you knew that the whole horse would come like in two days or something like that, and during that time you could sell a stock that you didn't own. Actually, that was the entire thing back then. Of course, today with technology it doesn't make sense, but it's such a great way to make money or to lose money that of course it remains. So to go back to the topic here, hedge fund can sell a stock it doesn't own. Imagine it sells the stock for $50, so $50 plus for the hedge fund, and then imagine the stock price drops. That's the goal. In this case, you are speculating that the stock price drops, and when the stock price drops, the hedge fund will buy that stock at $40. So as you can see, the stock has been sold at 50 and bought at 40. So the difference of plus 10 is what the hedge fund wins. So now your question is, well, why is the stock price dropping? Well, and this is very controversial as well, because hedge funds, when they bet on a stock going down, for example, they will do a lot of bad publicity. They will do a lot of research, or they have done a lot of research that a stock price, for example, is overvalued and these kind of things. There are a lot of kind of clean and bad practices about that kind of stuff. But the thing you have to remember is, when it comes to short selling, is that the hedge fund is speculating on a drop in price, and then will make will win the difference between both. On the other side, if a hedge fund goes long, it means basically that it's gonna buy a stock and speculate that it goes up. Actually, it's the other way around. As you can see in both cases, when you go short, it means that the hedge fund is speculating that the stock will go down, and if the hedge fund goes long, it means that the hedge fund is speculating that the stock price will go up. The third way for hedge funds to beat the market is to use derivatives. So what are derivatives? Well, they're hedging instruments. I could make a very long talk about it. I will not, because I made two very specific videos about hedging and hedging instruments. So if you want to get more specific and dig more into details, you can watch these two videos. It's going to be very helpful to understanding what derivatives are and how they are used either to hedge risks, so reduce risk, or to speculate. The big final question: are hedge funds either useful or are they dangerous? Let's start with the useful stuff. First of all, hedge fund contribute to market transparency. What does it mean, market transparency, actually? The thing you have to understand with hedge funds is they're taking bets, right? As I explained it. And let's say for short selling, for example, if you are expecting or if you are planning that the stock price will drop, you will do a lot of research, because otherwise you would not speculate that the share price dropped, right? You invested a lot of money and are speculating on a drop of price. So there has to be some good information behind. And what is happening, and it happened in the past, that a lot of big financial scandals which were not known by the financial markets, well, they were kind of dig up by the hedge funds, because when the hedge funds started to dig in the company's history or in the books to show that they were overvalued, so that they can pocket the difference between their speculation, actually. Well, a lot of financial scandals have been found through hedge funds. So this is why it contributes to market transparency. That's pretty important. Then a hedge fund also adds liquidity to the markets. Why? Because, as I mentioned before, hedge funds are like more riskier financial vehicles. So actually that's why they buy and sell a lot. And because they buy and sell a lot, there is more money going into the financial markets and more shares that are exchanged, which is generally good for the market itself. And then, of course, a hedge fund is a very specific investment option, right? If you're only having pension funds and very passive funds, well, you're kind of limited. So the hedge fund, especially if you're a rich person and if you like more riskier bets, it gives you a different approach, a different risk exposure to the market, which is a plus because it gives you more options basically. So why can hedge funds be dangerous? Well, the first point is market manipulation. As I said, they represent a lot of money. A lot of money is invested into hedge funds. To give you a rough estimation, more than $3 trillion are invested into hedge funds, which is roughly the GDP of Germany. So the thing is, when you have that kind of money, and if you are speculating that, for example, the Tesla stock will go down, well, you will probably do a lot of shady tricks that will kind of that will lead to market manipulation, because you will probably put out a lot of false rumors, a lot of false information that will to make sure that the share price you are betting on will eventually drop, for example. So this is kind of a big deal here, market manipulation possible. Then, of course, there is destroying companies. Let's imagine you are betting on, let's say, Tesla or another company, that the stock will go down because you're short selling, right? You're betting that the stock will go down. And in this case, imagine you are making up fake stuff, bad reputation for the company. Well, it can, and as the goal is that the share price should drop, well, you can actually kill a company just by making a lot of false rumors about it if you are big enough. So that's a big risk, of course. And then there is also the systemic risk. Systemic risk means the risk for the entire financial sector. Why am I saying that? We learned about it in the financial crisis, 2007 to 2009. If you have a lot of high leverage, so if you're not playing with your own money, that can lead to a big damage for the entire industry. Because let's imagine if you're going to the casino and if you're only playing with your money, that's fine if you lose it. But imagine if all the banks and all your friends have given you money and you lose it in the casino, it's going to be a systemic risk. So that's the take from my side. Now I wanted to ask you, what do you think about hedge funds? Do you think they're useful? Do you think they're dangerous? Let me know in the comment section below. Otherwise, I wanted to tell you that I post this kind of content, corporate finance, market finance, every Sunday, so once a week. So if you like that kind of stuff, make sure to like the video. It takes me about 6 hours of research and cutting and stuff to do. And don't forget to subscribe if you wanna have more content. Otherwise, I wanted to tell you, enjoy your week, stay connected, stay smart. Bye bye, guys.